Do you dare to bet against the Warren Buffett? If the stock market crash in 2000 happened because of the internet bubble, and 2008 happened because the banks faced a liquidity crisis, then if right now we not only have an AI bubble, and the banks also have a liquidity crisis, wouldn't the consequences be worse than 2000 plus 2008 combined? You'll notice that before 2000, as long as you dare to buy US stocks with your eyes closed and hold for a few years, you would find out the money in your wallet is getting more and more. Before 2008, it was the same. In other words, for most of the time, the US stock market rises more than it falls. So if you want to short the market ahead of the year, it crashes. Isn't that extremely difficult? But here's the problem. In the past few years, Buffett shorted the US stock market twice. The first time, he said, "I don't understand the internet, so I can't buy it." And then the 2000 internet bubble burst happened. The second time, he said, "The financial derivatives are demon. It's already out of the bottle." Then the 2008 financial crisis crash happened. So what about this time? He said two things. "I don't understand AI, so I can't buy it." And the US dollar is going to hell. What does that mean? Hello everyone, I'm Money Zen. Many people say it's impossible. Buffett has never shorted the US stock market because in their minds, shorting is like what Soros did, borrowing most of the shares held by retail investors and dumping them all at the same time. Then the stock prices get smashed downward, right? After the stock prices plunged, it triggers more people to stop loss. So it will furthermore smash the price down. And in the end, Soros can slowly buy the shares back at the bottom, return them, and pocket the profit. To put it simply, I borrow your shares, sell them high for cash first, then wait for the stock price to drop. I buy them back cheap and return them to you. What about Buffett? He didn't borrow shares and he didn't dump the market. He even said, no one can get rich by shorting the US. Never. So Buffett has never shorted the US market. Is this really true? The key point of shorting has nothing to do with whether you borrow shares or dump the market, because these are just methods. Shorting only has two steps. First, sell out at a high price. Second, buy back at a low price. As I just said, before the crashes in 2000 and 2008, the stock market was soaring to new highs. And what did Buffett do? He sold his stocks. Isn't that selling high? Then after the crash, he used the massive cash to buy the dip. Isn't that buying low? Is that not shorting? In other words, Buffett shorts too. He just shorts in a deceiving way. Buffett shorts too. He shorts without letting you feel like he's shorting because he doesn't dump the market to bring it down. But what about now? Last year, Buffett had just over $300 billion in cash. It's already a lot, but now it's almost $400 billion. That amount is more than what many countries' central banks hold. What does that mean? Do you really think Buffett is holding so much money? He is planning to hold this cash forever? Or to be blunt, is he planning to take it to the grave? If you are over 90 years old now, you can sell your stocks, cash out, and spend slowly until the day you die, because that money belongs to you, right? But Buffett is different. This money is financed, which is he borrowed. In other words, he's paying interest for the money every month, and it's depreciating because of inflation. So the cash in Buffett's hands is not the cash we understand. For him, it's a liability. He's just putting the money into short-term US treasuries to earn some interest and reduce that liability. So the question is, what kind of return would make the god of stocks rather carry liability? Just to sell his stocks? Some people say, Buffett sold his stock and held cash, not for making money. He just wants to leave cash for his successor, so they can invest and show their talent. Can you accept that explanation? Let's say you're a billionaire today. You built your empire and you're about to retire. To let your son, who born with a silver spoon, to show his talent, you sell all the valuable assets your family owns. Leave the principal to him and let him spend however he wants. Does that make sense? If someone who isn't short on money sells all his assets but doesn't spend the cash, there's one possibility left, and only one. He sees a trap that everyone else cannot see. And right here, some people might still not realize Buffett has already successfully completed the first step of shorting, which is selling high. Where did his nearly $400 billion cash come from? From cashing out stocks. Of course, the US stock market hit new highs over the past 2 years, and he kept selling. Isn't that selling high? And what about buying low? In April, the US stock market plunged more than 20%. Buffett not only didn't make a move, he sold even more stocks after the rebound. What does that mean? It means this 20% plunge was just an appetizer, far from enough to satisfy the old man's appetite. What he's eyeing is the steak behind it, and that steak is already prepared and about to be served. So, are you going to follow market euphoria and the rushing at historical highs? Or are you going to think about the man who holds the most cash in his history? What kind of tsunami is he actually seeing on the distant horizon? If you choose to follow the stock god, then you can't miss a single signal I talked about today. Because this kind of bottom fishing opportunity is something we only need once in our lives to multiply our net worth countless times. If you don't want to become a victim this time, or even wants to climb to a higher class, then you should subscribe to my channel, because I'm gonna be giving you more information like this. And if you're worried you'll forget everything after hearing it, and you don't want to waste your time, you can like this video, and it will be automatically saved in your playlist, so you can come back and follow it anytime. First, Buffett has been continuously selling stocks, and the main thing he's selling is his only AI-related stock called Apple. What exactly did he see? A lot of people immediately jump out saying, of course, it's because AI has bubbles. That old man won't buy what he doesn't understand. But that's just what you think. Do you have proof? Let's take a look at what happened after the Fed cut interest rates last year and this year. The US stock market hit new highs. Just Nvidia itself, it already reached a valuation of over $5 trillion. What does that even mean? It means this one company is worth 1.1 times Germany's economy, 1.2 times Japan's economy, and 8 times Taiwan's economy. In other words, if we treat Nvidia as a country, it will be the third richest country in the world right now. And the company has only 36,000 employees, less than 3% of Foxconn. So logically, if the better Nvidia's financial statement and the performance, the more profitable the company becomes. Then the US economy improves along with it. The Americans are more wealthy, right? And then we can see after the Fed cut rates last year and even this year, the non-farm payroll data kept decreasing. What does it mean? Folks, the Fed said the reason it cut rates was because employment data was worsening. So it cut rates to stimulate the economy. In economics class, teacher told us after the Fed cuts rates, the cost for people's borrowing fall, so people can borrow more money for business, hire more employees, so the employment data will be better. But now, what are we seeing? The Fed has already cut rates, yet employment data have gotten worse. Doesn't that show that rate cuts is no longer useful to stimulate employment, right? We can only see the data up to August. Why? Because the US government shut down in October. No one is tracking the data anymore. They just made the data physically disappear, but that's fine. There's a company that specifically tracks hiring and layoffs, Challenger. And they gave us an answer. In October, US employers announced 150,000 layoffs, increased 175% from last year. This is the highest October layoff count since 2003. To put it simply, the level of be fired in the US last month was even worse than during the 2008 financial crisis and the 2020 pandemic. In other words, rate cuts sure did let AI companies like Nvidia make money, but Americans, they were laid off on a massive scale and couldn't find jobs. You can check the news. Microsoft is cutting jobs. Facebook, Nvidia, Amazon, Google, UPS, Netflix. Basically every US giant you can name is doing massive layoffs. What does this mean? Only two possibilities. First, the Fed did cut rates, and borrowing costs for businesses indeed became lower. But after these AI giants borrowed the money, they didn't use it to build more factories or hire more workers to boost employment. Instead, they bought more of Nvidia's CPUs to develop more powerful AI models that permanently replaces more American workers. This creates a dead cycle. The Fed sees more people can't find jobs, so it cuts rates and prints money. Then the money lands in the hands of these giants. They develop more AI, and even more people lose jobs. So the Fed's rate cuts end up causing more unemployment. Isn't this just like what happened before the Great Depression in 1929? After the technological revolution, a job that used to require 10 people could be done by one person. Now, the other 9 people become unemployed, which means they have no money to spend, may even default on their mortgages. Then restaurants, clothing stores, and banks earn less. Then they start layoffs and eventually go bankrupt. And the more the Fed prints money, the more money these companies receive, and the more they invest in new tech that makes even more people to lose jobs. So if you believe AI is like the third industrial revolution, then the more money the Fed prints, the more people lose their jobs. That's the first possibility. The second possibility, which I personally believe more, is that after the Fed cut rates and printed money last year, it's the same. The money still first landed in the hands of AI giants. But instead of developing AI to replace workers, what they're actually doing is a self-reinforcing capital recycling loop. As I mentioned in the last 2 videos, today Nvidia invests money into OpenAI. OpenAI gets the money and buys Oracle's computational services. Oracle receives the money and buys NVIDIA's and AMD's chips. Nvidia and AMD receive the money and invest it back into OpenAI. This forms a loop. In the end, the money circulates among us, a few companies. Our actual money doesn't increase, but our products get sold, our earnings look better, and our stock prices go up. And throughout this whole game, there's no need to build factories or hire workers. In fact, every time we cut 1% of our workforce, the money saved can buy another batch of NVIDIA's top AI chips. As long as the numbers circulating in this loop look bigger, our financial statement and performance look better, because layoffs reduce our costs and at the same time, we sell even more products. Do you get it? So, whether you believe AI is replacing human jobs and causing massive unemployment, or you believe AI is a bubble, these giants are just doing a self-reinforcing capital recycling loop through layoffs to make their financial statement look better and push up their stock prices. You realize that whatever the actual reason is, no longer matters anymore, because both point to the same loop. The more money poured into AI, the more people lose their jobs. Everyone becomes poorer, and the economy worsens. And at the end of this loop is the enormous wealth created through the AI concept is eaten up by top capitalists and shareholders, while the unemployment and the consumption downgrade caused by AI is paid for by ordinary people. But Buffett is selling stocks instead. Jensen Huang, Bill Gates, Zuckerberg, Bezos are all selling. Even Cathie Wood, the female version of Buffett, she's talking AI bull for the most. The one who keeps rushing all in on tech is also selling AMD and PLTR and warning that AI valuations may be facing a reality check. Started questioning whether these tech companies, after throwing in so much money, can AI actually make any profit in the end? So a lot of people are asking, US stocks are way too high now, and gold and silver have risen so much. Is it okay to invest? People who are asked this, their understanding about the investment is still stuck at insider information. Holding long term and buy low, sell high. And then, in the end, it's the opposite. Buy high, sell low, or get trapped. Why? Because they use the institutional investors method for retail investors trading. Now, the real question is, after these big players cashed out, holding massive piles of cash, what are they waiting for? They're waiting for a liquidity crisis strong enough to reboot the entire system. Using the liquidity crisis I'm talking about is still something simple like 2008. When Lehman Brothers went bankrupt, I'm telling you, this time the game has been upgraded. Right now, the US government is shut down, right? But you'll notice the US TGA account, which is the Treasury's general accounts balance, keeps rising. What does this mean? The government shuts down. It stops spending, right? All civil servants and all the companies that rely on government contracts stop receiving money, right? But Americans still have to pay taxes to the government as usual. So doesn't this mean the government is draining money out of the market, but can't spend it out? Isn't this equivalent to freezing market liquidity? And how much has it drained out? $1 trillion. The treasuries that the China hold now is only about $700 billion. So this $1 trillion is enough to pay back what the US owes China. But that's not the point. The point is, when the government drains $1 trillion from the market and banks, it's equivalent to the market needing to pull back $10 trillion. Because in the bank lending process, they leverage up. Even if they only hold $1 trillion, but they can lend out $10 trillion. So when banks need to hand $1 trillion to the government, they actually have to retrieve $10 trillion from the market. Let's discount that. Say not $10 trillion, that much. But $5 trillion, now you think about it, the market has $5 trillion of liquidity frozen, and the government can't spend a single cent. Those companies waiting for government payments have already waited a month, and they're still waiting. If they can't get paid, what happens? They can't repay their debts. Their debt to the banks becomes bad debt. And when banks can't recover their loans, a liquidity crisis occurs. That's why 2 US banks have already collapsed. Crisis happen is fine, actually. Because as I said in the previous video, banks and Wall Street save 2 sums of money at the Fed. One is called reserve requirements. The other one is called overnight reverse repo. If a crisis happens, they can use these 2 sums to save themselves. But here's the problem. Check both of the money. The reserve requirements are already reaching the red line, and the overnight reverse repo has shrunk from over $3 trillion to only a few hundred billion. In other words, both of the emergency blood banks are basically drained. So when a real crisis occurs, the market has no money to give banks and Wall Street a transfusion. Because of this, the Fed has been forced to stop quantitative tightening. Watch the previous video for details. And now comes the most important one. Why can the US keep issuing more and more treasuries without paying them back? Just in the past few months, the US government suddenly can borrow another $2 trillion. Why? What's the game rule? Borrow new debt to pay the old debt. It's like you owe me $1 million and it's due today. What you gonna do? You go to the bank and borrow 1.05 million from the bank, and you take that 1.05 million to pay back my $1 million principal plus $50,000 interest. What's the result? Your debt deadline is pushed back, but you did nothing, and your debt automatically inflated. And here's the problem. Why don't you borrow from me or the bank for 30 years so that you could delay paying back the debt? Because we're not stupid. Seeing how recklessly you spend, there's no way we trust you to pay back in 30 years. So we are only willing to lend you for 3 months. This leads to a fatal consequence. Your debt maturity gets shorter and shorter. Your repayment pressure becomes more and more frequent. Instead of repaying once a year, turning to repaying every quarter, even every month. You gotta figure out how to repay. This is the US Treasuries now. So the US invented a backholder called stablecoin. They mandated that every company issued $1 of stablecoin must be backed by $1 of short-term US Treasuries as collateral, which means in an instant, all the hot money from global leverage gamblers, crypto traders, and speculators all flowing through the stablecoin channel to become the final forced buyers of US short-term treasuries. This system was good until recently. When the crypto market plunged, those crypto speculators with 10 times, 100 times leverage blew up. They had no choice but to dump stablecoins to cash out for surviving. These forced stablecoin issuers have to sell their assets at any cost, which is the US short-term treasuries. The stablecoin backholder became the most ferocious market dumper in an instant. So when the last buyers in the market, stablecoins are also dumping short-term treasuries. This game is done. The Fed stepped out and told the world, the US treasuries can now be rolled over. What does that mean? The Fed is the biggest creditor of the US government. He holds massive amounts of treasuries. Now, the Fed tells the government, you don't need to repay the principal anymore. All you need to pay is interest. A few years later, if you still have no money, you can keep rolling it over again, even for 100 years, 1,000 years. It's like you borrowed 1 million from me today. Originally, you needed to repay 1.05 million in principal plus interest. But now, I just need you to give me the 50,000 interest, and you can keep the 1 million without repaying. Then, during the whole case, did you technically default? No, because it's me. The creditor requested. You only need to pay interest. But the whole case, isn't this equivalent to the Fed admitting that the US government can no longer even play the borrow new debt to repay the old game. They can only afford the interest. They can't even pay the principal. The US government's repayment ability is getting weaker and weaker. So what's exactly happening now? The US banking emergency funds are gone. The US government, it can't pay back principal anymore. Even the borrow new to pay the old game is done. So you still think I say these things to predict the crisis? Hasn't the crisis already emerged? It's just that many people still think it has nothing to do with them. If you agree with what I've said, then what's the next step? If banks really collapse and there's no emergency money left, won't the Fed be the only one left to do quantitative easing to rescue them? Nobody is buying US treasuries right now. Yet, the US government still keeps issuing more. But the market no longer has money to buy it. So in the end, isn't it still the Fed doing QE to buy? And then, the US stocks are still at high levels. Do you think the Fed will print money to push the US stocks even higher? Or let it fall first, then print money to pull it back up? During the 2020 pandemic, the US already crashed once. Back then, they printed $4 trillion. So if it crashes again this time, how much will they have to print? In 2000, what was destroyed was an entire internet industry. In 2008, what was destroyed was a group of financial institutions. But this time, if it really crashes, what gets destroyed? Might be what Buffett said. The US dollar is going to hell. If you have a better understanding, welcome brothers and sisters who has a different opinion. Feel free to leave a comment down below to discuss with us. Due to time constraints, I have to end here. But what do you anticipate in the next episode? A lot of people are waiting for this line every week. It's gonna be a crucial one. Alright, I'll continue sharing tips on how to become wealthy, how to be an entrepreneur, an investor, and achieving financial freedom every Sunday at 8:30 p.m. If you don't want to miss out, make sure to subscribe to my channel and click the little bell. And generously share this video. I sincerely wish all of you who like this video will reach financial freedom soon. As long as you can find 1 or 2 useful sentences in today's content that can help you live a better life, I'll be completely satisfied. Alright, I'll see you next week. Bye!